Hey everyone, this is Robert Keens with goldsilverpros.com. It is Tuesday, November 24, 2020, and we have a hell of a lot of interesting price action going on, not only in the precious metals, but in the cryptos. And I'm going to get into both of those today and tell you what the heck is going on and how gold is being slammed and silver is being slammed, but a lot of the cryptos are being bid up, and a lot of it has to do with the futures market action, which, as we know, and we've been documenting for quite some time, is used to manipulate the markets up and down as per the needs of the wealthy and the financial institutions that use those. We'll get right into the data. Go ahead and get started looking at the gold price. So gold has been slammed for 2 straight days. It's now down to 1806.99, and we'll get here to the chart in a moment and show you where it's just pounding down through downside resistance or downside support, if you will. Silver's down to 23.19. They've both been getting slammed, although I think gold has been taking the lion's share of the beating. This is the long-term chart, and I've been talking for the last 2.5, 3 months about a potential handle forming here in gold, where you have the cup formation and then you have the handle form, which could bring it down maybe into the $1,700 to $1,800 range. I don't know if that will continue, but this sure as heck looks like a handle, and handles don't go straight down. They go kind of out at about a 45-degree angle, and that certainly looks like what we've got going on. And you can see that gold has pierced the downside to a lot of the support lines. It's pierced this basically since late 2018 when it started rising. I drew this little parabola here showing the trend direction. It's pierced through that. It's pierced downward through the 50-day moving average and is approaching almost at the 200-day moving average, which is 1798.95, I believe, by looking at the chart. Let's go to a shorter term view of the chart and show you what's happening in gold. And then we'll get into the futures market action and show you why the gold price is going down. It has nothing to do with physical trade, as I've documented on this channel ad nauseum. It has to do with the futures markets, and the data is there for us to see. So as you can see, here's the green parabola I drew, which is showing the trend since late 2018, since we had the 20% stock market correction, when the Fed tried to tighten quantitative easing, tighten up the monetary markets. The stock market corrected by over 20%, and some of the markets 25%, and then gold started rising and basically hasn't stopped that trend. Well, now you saw the price back late September fall through that trend line. It tried to come back up to meet that trend line for the last year, almost 2 years now, and it didn't quite get there, and then it fell back down through. You see on November 9th, it was basically a hit on the gold market with this massive, absolutely massive amount of shorting going on, which is the most since we saw back since August and September. And that, look at the straight line down. We had a video on that a couple of days after that occurred, or a day after that occurred, talking about the ridiculous move in gold. That's an engineered move because of all the paper market trading. This is what this red bar is. It's the negative volume in paper futures trading going on in the market, which brought the price down that day. And there's continued to be a plethora of additional short paper, which has brought gold down through the blue squiggly line here, which is a 50-day moving average, and back down to the 200-day moving average on the short-term chart. On the long-term chart, it's challenging the 200 moving average. So that's what's happening in gold. You can look at the volume. You had a nice spike up in volume on the 23rd, 443,000 futures contracts of 100-ounce gold are traded on a day, which is a ridiculous amount. And a lot of it was to the short side. We'll look at the settlements here. As you can see on the 23rd data, we had, for the December contract, we'll highlight this row right here, you had 320,000 contracts of 100-ounce gold settle at about 1837.80, which had brought the price down from what it was. And then on Tuesday, November 24th, we had another 338,000 contracts settle at 1804.60. And then we had, for the February contract, 119,000 settle at 1810.9. So what that does is, when you have a lot of the near-term paper settling at lower prices than what gold was the previous day, it brings that price down. That is in fact how the spot price is determined. It is the next nearest delivery month, which is in this case in December, which has the most contract action, is the average of all these price settlements is what determines the spot price. When you have a massive amount of short paper coming in, or contracts coming in at a price below the current gold price, it brings that gold price down. That's exactly how the market works. And you can see this dating back to the 20th. We had 186,000 contracts at 1872. So if we start here on Wednesday, we get 5 days of data on COMEX. They start at a higher price, or start at this price level, which is still lower than what the gold price was. I think it's trading close to 1900 at that point, and they do 209,000 contracts at 1873. The next Tuesday, 200,000 contracts at 1861. The next day, 186,000 contracts at 1872, actually closed up a little bit as the longs came in, tried to get the gold price up. Then they went to 300,000 contracts, another 140,000 contracts to the short side at 1837, and then another 338,000 contracts at 1804. That's why the gold price is going down. So when you look at the volume chart, it's not good enough just to look at these blue bars. You have to go to settlements and see what direction it's going, and is the price below or above, and that's what drags the price down. Of course, you go back to this chart, it basically shows us the same thing. The days I was showing you this massive volume, paper volume to the downside, or at a lower price than the spot price was trading at that moment, these are red bars. And you've had more red bars than gray bars, which are the longs, and you have this massive slam down on November 9th. Something similar is going on in silver. We had a nice almost vertical rise due to the shutdowns through the spring and through the summer, especially during that June, July timeframe. We started having a ton of physical deliveries on the COMEX. You guys remember back to that July 14th video where I kicked off this whole COMEX series where I was talking about those deliveries and how it spiked the price up. And it continued to spike the price until they started hammering it down basically in August, September timeframe. They hammered it down, and we've got that action. We'll look at the short term here on stock charts and see what we've got. Again, we had the smash down on November 9th, exact same day. They had the paper smash on gold, they had the paper smash in silver, and you see the price cross back down through the 50-day moving average and through the critical support of 2450. This line right here, this little yellow line, if you can see it right here, which is a support line from the last bull market from 2009 to 2011. That's a critical support line. They smashed it back down on November 9th because it had risen above, and you can see it was headed towards $26, $27. Next stop really was going to be 30, back up in this range actually. They didn't want to get it to 30, so they smashed it down with this massive shorting. The longs came back in, tried to bid it back up. As soon as it touched on that 50-day moving average, algorithms came in 3 straight days right here and smashed that silver price. And when it tried to spike up again, that's the longs bidding it up in the market. They smashed it back down again with November 23rd's data. Again, that's all that happens in the precious metals markets. It's slammed down of the paper. So let's go back to what we were seeing in gold. Let's go back to silver. We're going to trace back 5 days. We're going to go over to settlements. We'll go here to Wednesday, November 18th, get that data loaded. You saw 82,687 contracts for December. 5,000 ounce silver closed at 24.44, which was below the silver spot price on that day. The next day, they came and slammed it with 95,000 contracts down to 24.048. The next day on the November 20th, they came with 76,000 contracts at 24.36. And on Monday, they came 106,000 contracts at 23.63. And on Tuesday, almost 100,000 contracts of 5,000 ounce silver at 23.30. And that's why you're seeing the price where it is now. It's trading at about 23.30 right now, 23.20. So you can see that's exactly how they bring the price down. They just go smash it with a bunch of futures action. You can see it here on the settlements tab. And that's what happens when you offer a lot of short paper to the downside. That's what happens to the price. That's exactly how it's determined. And that's why gold and silver are coming down. Now, I want to reiterate, for those of you buying physical gold and silver, don't worry about this. This is an opportunity to buy. This is not reflective of the actual physical market nor the tightness of the market. And the reason they're bringing the price down now is because we have the big delivery month coming up in December. Remember, we have all this open interest in December in both gold and silver. In gold, we still in December have 153,000 contracts, 719 contracts of open interest. If even a fraction of that were actually delivered here in this column, you would see an amazing amount, an absolute amazing amount of price rise, because that would signal a lot of physical demand. And we've had physical demand. You can see there's still a lot of deliveries going on in the November contract as we close out the month. 1,891 on Monday of this week. We had 91. So last Thursday, 122. But look at this number on Monday of this week, but before we get to December deliveries, because I think there's going to be a run on gold in the COMEX in December. Before we get to December deliveries, people are coming in almost on same day contracts in November and closing out 1,891. That was a lot more in the open interest. The open interest only 815 contracts, but 1,891 closed. That means people are coming in literally and getting spot gold off the market in November, a thinly traded month. But in order for that not to spike the price up, they had to come and smash down with the paper, the price. That's how it works. I've explained this many, many times. But remember, if you're long gold and silver physical, don't worry about the price. The price is just the paper's futures trading. When they run out on COMEX of the actual gold and silver, you're going to see the actual gold and silver price separate from the spot price, which is determined by the futures market. And meaning you're going to have premiums. If you want to go buy gold and silver, you're going to pay exorbitant premiums. That's exactly what happened back in March when we had the shutdowns and there was a lot of fear in the market. People were going to get gold and silver, and we're not talking a lot of people, because only about 0.5% of Americans invest in gold and silver. So maybe, I don't know, another, 1/3 or even less, maybe 1/4 of 1% on top of that were expressing some interest, and the price spiked because of physical demand. You remember that's what happened? And you had these premiums when you went to go buy it at and above what the actual spot price was trading in the futures market, and you had that separation. Okay, that also occurred in 2011 when gold was spiking up to $1,900 now. So we're going to see that again. We're going to see when the physical markets get tight, and we've heard reports of 1,000-ounce physical bars being bought by one bank and being taken off the market, and how it's hard to fill large orders of silver. Gold, there's a little bit more out there, but it's starting to get a little tight, and there's a lot of deliveries coming off of that market. You're going to see the price separate. You're going to see the actual price that you actually can buy and sell it at physically in the market separate from the futures, and that's coming. But in order for them to get the price down to take those deliveries in the big December month, they've got to smash the price down. That's why the price smashes are coming. They're coming before the first delivery day for December, which is not too long. It's basically going to occur next week. So they got to smash it down this week, and that's what's going on. I want to now shift gears to crypto, because the entire crypto market is being bid up. In the last 24 hours, according to Coinbase, the entire market is up 5.24% for all the ones that they track. And it's all of these down here on this chart. So pick your crypto, the top 50 cryptos by market cap are up 5.24% in 24 hours. Now, that's not the astounding thing about crypto. I've got a monthly chart here. 1 month, Bitcoin is up 47% in a month. Ethereum, 47%. XRP, which is by the company Ripple, is 177%. Now, XRP, I'm going to go into more depth here. XRP basically is owned and collaborated on by banks and financial services companies. That is more of like a commercial version of a digital ledger technology that they're trading that coin on. It's not really a derivative of Bitcoin. So it's not meant for the retail market. It's meant to facilitate the commercial market. And I think that's why it's been bid up. I'll get back to that in a moment as to why that's extremely important, XRP versus the other cryptocurrencies. Tether's down just a tad, but that's okay. It's marked to the dollar. The price doesn't matter. What matters is the actual market cap and the volume to Tether, because it's always going to be it's supposed to be equal to $1. So they're supposedly taking in dollars to issue Tether. Of course, our interview recently with Karen Von Hest, also known as Dezo, indicated that the last audit they did, which was a spurious audit, but the audit they did indicated they didn't actually take in dollars from Tether. So issuing more Tethers are taking in dollars. That's a whole nother video. We'll get into that later. But look at the rest of the cryptos. Even Bitcoin Cash is up 28%. Chainlink 28%. Litecoin 61%. Stellar Lumen's 120%. All of these are in the green. So it has nothing to do. NEM, XEM 50.23%. Look at that one. 60% on Dash. 36% of Zcash, Uniswap 35%. So when the entire complex gets bid up, there's a reason. It's because if you think about it, there are about, I think, almost 5,000 cryptocurrencies now out, if I have my numbers correct, that are offered. Of course, the top 50 is what most people follow. The top 10 really is what most people follow. But when the entire complex of top 50 is bid up with one or two little tiny exceptions, that means that somebody's coming in, big commercials are coming in, and they're bidding it up. This is not retail investment. Retail investment is not going to bid up the entire top 50 crypto market 5% in a day. It just doesn't happen that way. That'd be like somebody coming into the COMEX and bidding up the entire commodity sector, everything at one time in the same amount in a 24-hour period and over a month period. It doesn't happen that way. Actual market trading means that some things are going to go up, some things are going to go down. When the entire market goes up at one time or down one time, that's intervention into the markets. Let's look at Bitcoin. It's now 19,257.52 according to Coin Market Cap. Total supply 18,552,000. Market cap is up to 356 billion USD. Now this is tiny compared to the gold market, which is a much higher number. I actually did the numbers on the gold market. You have about 6.1 million tons, I forget, multiplied by $1,800 comes out to be a $10 trillion market cap. So gold is right now almost $11 trillion market cap, all the gold ever mined. Bitcoin's only 350 billion. So Bitcoin is a tiny little market compared to gold. So it's actually easier in a tiny little market like that to bid up the price using Bitcoin futures, for example, which we'll get to here in a moment, and buy large commercials than it is to move the price of gold and silver. So it doesn't take as much manipulation to do that as it does in gold and silver. In gold and silver, you see these massive volumes come in and shorting at 153,000 contracts. You don't need that much of Bitcoin. So the reason I say that is because when you look at Bitcoin and Litecoin and XRP and all these that are going up, that can be done pretty easily if you want to centrally engineer the price moves all at one time, like we saw on the past chart. It doesn't take that much. It takes a lot less to manipulate those crypto markets than it does even gold and silver. And we know how effective they are at manipulating gold and silver. So just keep that in mind as we get in here. I want to look on the COMEX at the Bitcoin future settlements. We're going to go back 5 days. I got this back to November 17th. You're going to see how they've been bidding up Bitcoin futures. Now, it's when they're bidding up Bitcoin futures, they're taking a long-term bet on Bitcoin, and then they can settle in Bitcoin. And what that does, it has the same effect on Bitcoin as it does in gold and silver. So for the November, December contract, look at November, you have 9,408 volume at 17,730, which was a higher price than Bitcoin was trading at that day, which pulls the price up, and then 1,500 in December. And look at the numbers as we progress in the last 5 days. 17,685, you have 12,000 contracts. And these are 5 Bitcoin each contracts. So if we look at the contract specs, I'm going to run over here in contract specs. It's 5 Bitcoin each. So remember, there's not near as much Bitcoin in the world as there is gold. So when you're doing a contract of 5 Bitcoin, that's a substantial amount percentage-wise as is a gold contract to all the gold mined. In fact, if you talk about, 6 million tons of gold ever mined, and the average contract's 100 ounces of gold, that's a lot smaller per contract effect per the overall gold mine than is 5 Bitcoin out of 18 million that have been issued. So it actually, each contract in Bitcoin can have more of an effect than it can on gold and silver. Now let's look at Thursday progressing through the days. Again, higher price, higher settlement price in November, 18,095, and December, 18,240, and a good amount of contract volume going on. Look at the contract volume on Friday alone, contract 9,812 of 5 Bitcoin, 2015 in December, prices going up. 18,685 for November, 18,870 for December. That means it's dragging the prices up just like it does in gold and silver. Now looking at Monday, November 23rd, you had a whopping 12,000 contracts of 5 Bitcoin settled at 18,410 and then 18,620. Now looking at the Bitcoin price itself, we're now trading at 19,257. So what's going to be interesting to see is what today's data is, which will come out tomorrow. We'll get November 24th data and see how many contracts came in and at what price they came in. Because I think what's happening to Bitcoin, it's not just people trading Bitcoin itself that's pulling up the price. It's the effect of the futures market. The futures market is how you control in bulk, in mass, anything that trades, whether it be sugar, corn, wheat, gold, silver, or even cryptos. And that's the key to understand. And remember, cryptos are a much smaller market cap wise than is gold and silver. So if they can manipulate an $11 trillion market in gold pretty easily, they can sure as heck do it in the smaller 350, 150 billion markets of the various crypto coins. It's very easy. It doesn't take a lot, especially when a lot of these are leveraged. Now on Bitcoin, on COMEX, it's 5 Bitcoin per contract. We're going to see an XRP later on where it can be actually higher. I wanted to pay attention to Tether here for a moment because Tether is supposed to trade at $1 each, and it does. You can see the price here gravitates towards $1. And they do that because they want to set it equal to $1. The reason they're doing it, I think, is because Tether is going to become, or supposed to become, the virtual dollar in a way. In other words, they're going to measure other cryptocurrencies in Tether instead of in dollars. And you'll see on the exchanges where you can, XRP, for example, is redeemable in either Bitcoin, the futures are redeemable either in Bitcoin or Tether, not dollars. And they do that on purpose because Tether is a stand-in for the dollar, because eventually I think the dollar is going to go away. Look at what's happened to the market cap in the blue line for Tether. It started stair-stepping up as soon as we had the shutdowns. And then it's been near vertical on one day in September. And then since September, it's gone up like this. Now, the only way for that to occur is for Tether to take in dollars and then issue more Tether. We know from talking with Karen Van Hess in our previous interview a couple of weeks ago, that's not actually the case. We know that they don't have all of those current dollars on their balance sheet according to their own admission and the spurious audit they had done months ago, which nobody really trusts anyway. But what they're doing is they're issuing more Tether than dollars. So they're flooding the market with Tethers. And I think the reason is to help settle an XRP, and I'll get to that here in a moment. We'll go to XRP and then I'll come back to Tether and Bitcoin and what I think that means. Here's an XRP chart, and you can see basically it's gone vertical in a day. It's The market cap right now is about, what is that, 34 billion USD. Again, not anything near the 11 trillion USD that the gold market represents, all the gold mined over the last 5,000 years. So it's a drop in the bucket. But XRP basically, remember, is a coin based on digital ledger technology owned by basically the commercial banking sector and financial service institutions. So in other words, this XRP is a replacement for the SWIFT system. Like if you're wiring something to somebody across the country or across the world, you use SWIFT. XRP, according to its founder, that had this idea in 2004 from my research, they wanted to replace SWIFT with something computerized, electronic, more efficient and cheaper. And that's where XRP eventually came out from, the Ripple company, which developed XRP and is developed by the financial industry. So it's not really a retail coin as much as it is a financial transaction system designed to facilitate crypto coin trade or crypto value trade across the world to replace SWIFT in the dollar system. So I think one of the reasons XRP is being bid up, and I'll show you how it's being bid up in the futures market here in a moment, because they want to replace a dollar. I think they know that the dollar is eventually going to collapse when the financial system collapses, but they need a system that represents a way to transfer value either from other cryptocurrencies like Fed coin or even retail currency, cryptocurrencies like Bitcoin and Ethereum and Litecoin across the world very efficiently. So there are about, I think, 150 servers which run the XRP network. And it's not a blockchain per se, and that it's not proof of stake or proof of work. It's basically 150 servers where they get really fast transaction validation, so they can do transactions very quickly. And this could replace the SWIFT system. And I think that's why they're bidding it up. They're trying to get legitimacy to XRP. And I think all of the cryptos are being bid up because they know it's going to be the end of the dollar pretty soon. Think about cashless society, things we've talked about. Think about the IMF plan to implement various Fed coins. Think about moving people off of cash in these societies, especially the US and the European nations who really stick to cash. Canada as well, it really sticks to cash. You got to move them off of cash into the cryptos, and they need a system that will facilitate international trade. XRP is that system. It was designed exactly for that. So I think they're bidding that system up a lot and manipulating through the futures market to give it credibility so that people will see XRP and say, oh, that digital ledger technology by Ripple looks legitimate. Hey, we can replace SWIFT. We don't need to use SWIFT in dollars anymore. We can convert our other cryptos, whether it be a Fed coin or retail coin, use the Ripple system using XRP to facilitate trade across the world. And I think that's what they're going to do. It's the general shift away from cash, away from the cash fiat system, which is dying, into the crypto system. Look at the Ripple future market. One thing I want to point out before we actually get to the futures charts is you can redeem XRP for USDT, which is Tether, which represents $1. Remember, Tether is supposed to be $1. So this trade right here is basically the crypto version of trading in dollars, but the Tether stands for dollars. It's the substitute. And then you can substitute it in Bitcoin, which is the most popular and the oldest, of course, retail. So you can go to Tether, which is a stand-in for the dollar, or you can go to the retail crypto market. And there's leverage here. So you can go up to 100 times leverage in Tether, and you can go up to 20 times leverage in Bitcoin if you want. What does that mean? When you have leverage like that, it allows you to take a very small position, but control a lot of that asset in a market, just like COMEX. If you're taking one contract in gold, it's 100 ounces. If you take one contract in silver, it's 5,000 ounces. If you take one contract in Bitcoin on COMEX, it's 5 Bitcoin. Same thing here with XRP. You can do 100x leverage on Tether trade, and you can do 20x leverage on Bitcoin. So now looking at what's happened, if we look at it in Tether terms, XRP and Tether terms, here's the rise that we've had just since the 20th. Just over the last 4 days, we've had this meteoric rise, and you can see how much you've got. You've got 214,248 contracts at 0.7117. The price now is 0.7113. This has gone up a lot from when I was viewing this earlier today. It was in 0.67, I believe, when I was looking at it earlier this morning. Now it's 0.7113 in Tether price. They've got contracts bidding up to 0.7138, 214,244 contracts. So that's a lot. And then, of course, you've got some down here at 0.7113, which is the current price. But you can see this is a leverage market. You can control a lot of XRP using these markets. You've also got XRP to the BTC. So let's look at that chart. Basically the same chart if you're looking at XRP and Bitcoin terms. There we go. We're going to look at this chart. It's basically the same thing. Highly levered, 64,000 contracts at at 0.003741. So anyway, you see a lot of leverage. And the whole point of me showing this to you is there's a lot of leverage in XRP, and that's how the price is bid up. If you go back to the XRP price chart, this is how the price gets bid up. It's not that everybody's trading using XRP at one time, actually using it as a currency. They're bidding it up in the futures market. Futures market manipulates everything. And then levered markets like the COMEX is, and like Delta Exchange is for XRP in both Tether and Bitcoin, that's how you move the price up, and that's how you move the price down. And the reason XRP is trading in both Bitcoin and Tether is Tether's a substitute for the dollar, and Bitcoin is a link to the retail cryptocurrency market. There's strategic reasons why they did that with XRP, why Ripple did that with XRP, because they want everybody, they know everybody's going to move into some sort of cryptocurrency. You're going to have the retails and you're going to have the Fed coin, the state issued coins. And XRP is a system in which they're going to be able to facilitate that trade. And XRP therefore has to be tied to Bitcoin, which represents the most popular retail crypto, and then Tether, which represents, quote unquote, the dollar as the dollar system dies. That's why they trade that way. And I think the grand plan basically is this. And we'll get off the screen share and I'll show you. We are going to Fed coin. I think the dollar system is going to die. I think when this debt collapse happens, the fiat dollar is going to be sacrificed. I think all the central banks are going to implement their own versions of their cryptocurrencies. I've talked about that in detail in my previous videos, how that actually works. It's been stated by the IMF. It's been supported by the central banks. They're all developing the technology. The Federal Reserve has the FedNow system. Europe has their system. China has their system. I haven't gone over the Chinese cryptos yet, but I'll do a video on that here pretty soon. It's even the scariest one. They're the farthest advanced in China than they are anywhere else in the world. But the systems are being laid out. We're going to cashless society. We talked about that in the IMF papers before, what they want to do. The BIS has come out and supported that. All these super national monetary agencies are all supporting that. A lot of the financial ministers and the central bank heads are supporting that. We're going that way. I don't think you can stop it. They're going to get rid of the dollars, and you're going to be in this crypto system. I don't think that they're going to allow Bitcoin and the other retail currencies to do things like pay taxes or be used for certain transactions because they want to suppress them. They don't want to suppress them right now. They want people to get used to using cryptos, but eventually they're going to suppress them in favor of the Fed coins. And that XRP system by Ripple is going to be the international SWIFT system, the ability to transfer value over time and distance like a wire is going to facilitate that. That's why they're bidding up XRP. They got to get the credibility of XRP up. At the same time, they want to bid down the price of gold and silver because gold and silver are true money and allows them to take it off the exchange. Well, why are they bidding it down if they want to actually own it and put it, in central bank coffers and in national coffers? Because it's a tier 1 asset. Remember Basel III Accord. Gold basically has the same value as cash. And when cash dies, gold is going to be the only basically tier 1 asset because the debt fiat system is going to collapse. So that measure of how much gold each each country has in their central bank is going to be the relative strength of their currency, but they're not going to trade gold and silver. Gold and silver is going to be the value. And on top of that, it's going to be all these Fed coins, all of these national sovereign coins. And that's going to be how we actually transact. It's either going to come on a card or some other method in which you can transact. I think it's going to be easier than the way that you transact Bitcoin now, which is very esoteric and a lot of people don't understand it. They're going to come out with cards. The FedNow system, you're going to have the Fed transferring money straight into people's accounts directly from the Fed as they issue money into people's accounts. Remember, we talked about the negative interest rates in the system and the bank accounts, how that's already been set up in the credit unions and the banks, so that when you get your deposit, say from your employer, they're going to discount it automatically. That discount automatically is how they devalue money over time so they can issue more virtual debt and pay for more social programs. The whole system is being set up, and I'm painting the whole picture for you as to why that's happening. So they want to drain all the gold and silver off the COMEX they can at cheaper prices. December's a big month coming up where they're going to take just a crap ton of it. That's why they're suppressing the price. And then after that, after they drain as much as they can, whether that happens December, January, February, March, whenever this scheme eventually ends, then they'll let the price rise because the only people that are going to own the bulk of it are going to be the central banks. And whoever owns it out in the world, like myself and you and I, who have been saving gold and silver, they're going to tax the hell out of it if you actually try to use it for transactions. I think that's a system that's coming. It's going to suppress gold and silver trading. They're going to get rid of the cash. They're going to bring in the crypto slowly. That'll take about 10 to 15 years to do. And they're going to have XRP as basically the SWIFT system transferring that value around the world. Of course, Russia and China have their own system, but this is going to be the Western version of it. It's going to be XRP by Ripple. And they've got to get XRP's value up. But that's why they're bidding up the cryptocurrencies. as they announce who's won the election and basically trying to settle things down and get things into place, even though I think that's still up for grabs, they're trying basically to suppress gold and silver as a safe haven asset, also so they can take it off cheaply. They're trying to build up the cryptos and move this into that system. That's the developments I see happening. And I don't think it's going to take that long. I think overall it'll take a while to get cash out of the system, but I think moving us in stages through that system is not going to take long. They're starting it right now. That's why you're seeing the crypto complex being bid up. It's not retail people going in and buying the crap out of all of the top 50 retail cryptocurrencies, and at the same time somehow bidding up XRP as well. That's not happening. What they're doing is they're doing it in the futures market. I showed you the futures market on COMEX for Bitcoin. I showed you on Delta for XRP and the pairs that it trades in. For Bitcoin for the retail market, and for Tether as the surrogate for the US dollar. And we know, of course, there are more Tethers issued than they have dollars in the books, but that's a different conversation. But that's what's going on, and want to outline the scheme and why what's going on is going on. Now, you may ask at the end of this video, why the hell should I own gold or silver? Well, because it's the only way to store wealth over time. Even if they come out with taxing regimes for it, there would be ways in which you can trade gold and silver that would be better than just dealing in cryptos. One, it'll give you anonymity, plus the value is going to be reset. When the financial reset comes, gold and silver are going to be worth a lot more than they're worth right now. So even if you get taxed some on the back end, you're still going to come out way ahead of where you are. Just remember, you're buying it at suppressed prices. And if they want to bid it down to 1700 to finish that cup and handle formation, take it, buy it at 1700, back up the truck, sell your house, your car, whatever you got to do. I mean, that's what I'm going to do. You have to do what you think is best, but get as much as you can, because that's the only way you're going to be able to keep value over time. They got negative interest rates in the banking system. They're going to issue Fed coins, which they're going to be able to control the value of. You're not going to be able to create value through those over time, through saving money, certainly. And the cryptos are going to be debased over time by negative interest rates. So that's what's coming. That's the big picture. That's why the crypto complex is being bid up right now ahead of December deliveries. That's why gold and silver are being suppressed. We know the system is going to be put in place, whether it's next month or the next year. It's coming. It's already been written about and supported the last 5 to 10 years by these international agencies. So that's what's going on. So I want to paint that picture for you. This is probably one of the most important videos I've ever done, because now I'm kind of giving you the overview of what's going on. And hopefully you guys understand what that means and you're able to prepare and not get upset at the gold and silver price going down. It's a buying opportunity. Buy it. The last thing I wanted to mention is, even though the gold and silver prices are going down, miners are going to be cheap right now. Miners will go up when gold and silver are repriced. In fact, with all the earnings that the miners are getting, I expect them to go up, in the next year anyway. So I think you're buying them cheap because they're going to start printing cash, even at 1,800 gold and $23, $24 silver. There's a lot of profit there. And when gold and silver are revalued, that's going to be a big pop in your mining stocks, because remember, you're going to be levered to the gold and silver price. So gold and silver increased by 50% or 100%. That's all pure profit, a levered profit on the mining company's books, which can make you a lot of money. So another way to play this market is getting some of the mining stocks as well. Anyway, this video is getting a tad long, so we're going to go ahead and wrap it up. Until next time, guys, this is Robert Keens with goldsilverpros.com.